Hi, I'm Pete Andresen of Andresen and Associates, and this is mostly directed at my clients. I just sent you this, the newsletter for June 8th, 2021. And I thought that rather than having a Zoom meeting, which some people can't attend and some people can, I would go over it on a Zoom meeting and record it and see how that worked. So let's see what happens. This is meant to be brief. So watch this if you're interested in my market comments about what happens next about the American and international financial markets and what's going to happen in the next decade. There it is. And this is June 10th, 2021. As we get started, the Dow last week was at 34,577. It was up 13%, up a lot, on the heels of last year's incredible historic rise. It's really something. The Vanguard 500 index, which we use for the proxy for the S&P 500 fund, is up 12.62%. So essentially the same. Stock market's up a lot so far this year. Since this is only June, you realize that that annualizes out at a 26% rate, which is absolutely boggling. However, the bond market, the Vanguard total bond index, is down 2.31%, and that's big. So let's switch over here and see if I can do this, see if I can pull this off. A little bumpy, not very. There we go. And let's see, share, boom, okay, we're in there. What can I say? It's amateur hour here, but it's getting done. Okay. Now, this is all basically covered by the June 8th newsletter, but I wanted to emphasize some points. And that is that we've been through, I'm going to take these off because my blended bifocals don't work at 2 feet. We've been through a real catastrophe. I don't think we understand yet just how bad COVID was. It was astounding. It was essentially the same as World War II, or more so, and more expensive than World War II. So we're going to talk about that. We're going to talk about the monopoly money economy and the sandpile effect as discussed in one of my favorite books. We're going to go down and talk about the fact that people don't perceive there's a lot of risk out there. We're going to talk about the debt explosion. There's debt being manufactured everywhere. We're going to talk about manufactured emotional manipulation by factions and agencies, which has actually always been happening, only now we can't get away from it because we're on the internet. Review some long-term investment returns. Those deserve another look. And we're going to talk about something that's really quite kind of remarkable, and that is that despite the Build Back Better rhetoric going on, the administration in the United States government itself expects a stagnant economy for the next decade, or a near stagnant economy. That's big because that's not what you hear in the news. We're going to review the fact that financial markets, all financial markets go in cycles, boom and bust. Sometimes more boom, sometimes less bust, but they still do have long-term cycles. They tend to run to the end of their leash. And then we're going to talk about diversification and discipline and caution and courage. I know that my what do you call these things? These are captions. These captions are blocking off some of the slides, but I'll cover them for you. Now, this is big. If you look at this, basically 80-year-olds plus got decimated in the COVID pandemic. We've been through a catastrophe here. We've been through a family disruption because older people tend to hold families together. We haven't really processed the grief. The other thing that isn't listed here are the number of people who died as a result of the shutdown, whether it was through delayed medical care or emotional angst or a change in habits, unrest. The murder rate is way up. We've all been through something big. So my guess, and I'm reading, is that we will be coping from the financial, social, and psychological effects of this COVID pandemic that is now, let's guess, it's 3/4 of the way done. As much as we're going to be coping from the COVID virus itself, and this is going to take years to shake out. Let me just lay one on you here. What happens if we find out that COVID really did escape from a lab? What are we going to do about that? Going to change a lot of people's views about China. The other thing, even though it might have been accidental, the fact is if that's true, they covered it up tremendously. Again, I don't know, and I don't think we should guess yet. The other issue is, what are we going to do about all the wealth distribution that's about to happen here? What are we going to do about the change in elder care that is inevitable, given the horrendous casualties we had in elder care facilities? So there's a lot of change out there. We haven't processed it. So now someone's going to call me, because I always get this call. Oh, I dispute the death count. You know, they counted everything as COVID. Well, maybe so, but a lot of people died. This is excess deaths. I mean, a lot of people died one way or the other in 2020. If you want to blame it on Martians, that's fine, I guess. The fact is that the COVID epidemic really took a bite out of us. It's going to take years to get over. In response to the COVID shutdowns and the COVID pandemic, the Federal Reserve has poured money on the problem. I cannot say if that's good or bad. I'm calling it the monopoly money economy because they're just printing this stuff. 35% of all US dollars in existence, or something like that. Again, that you can discuss how much have been created since March 2020. The fact is, M1 money supply has gone nuts. Now, traditionally, that causes inflation. That causes, you can look at behind me at the wall at the Russian inflation. We also earlier this year had a long discussion about the 1923 German inflation. Since it's not being printed physically, it seems to be going into speculation and creating financial bubbles more than inflation, although inflation itself is now back. We are now living in a somewhat government-controlled, centralized economy. Capitalism, the way we knew it, is not what's happening now. It's fueled by a gigantic debt expansion by the United States Central Bank. We call them the Fed, the Federal Reserve. This has resulted in financial bubbles forming in the stock markets, the bond markets, in real estate, cyber currencies, Bitcoin, whatever. A lot of investment going on. A lot of saving going on. The average American is actually proving herself or himself to be pretty wise, because a lot of it has not been squandered yet. But housing, we got housing. Existing home prices in the United States have risen for 39 consecutive quarters through the end of the first quarter 2021. In other words, there is a bubble in housing, and the Fed's money supply is helping to cause that. I got this statistic from By the Numbers Research. It's a nice, handy little one-page sheet I get once a week, and I use it very much, just to give me an idea where to study further, if nothing else. The sandpile effect is worth talking about here. In this book, which I have read and reread several times, Lawrence Gonzalez, the author, talks about how complex systems operate so that some sort of failure is normal, inevitable, and dealt with. The only problem is what happens when you're there when the sandpile effect happens. The sandpile effect comes from the idea that if you keep pouring sand on a sandpile, eventually there'll be a little slide in one corner or the other, because a sandpile is actually, in terms of physics, a rather complex assemblage. The same is true of the Federal Reserve. The same is true of the global economy, the United States economy. There's a lot of moving parts here. Failure of one of those parts or more of those parts is absolutely normal. For example, there was no way we were going to get through COVID without mistakes being made. Everybody's busy picking on Dr. Fauci or picking on the president or picking on that person or this person. The fact remains that when you've got 300 plus million people all trying to make complex decisions about something that we don't understand, mistakes are going to get made. So the same is true of the economy. We can't really blame anybody at this point. We can't really point fingers. What we have to understand, though, is that to some degree, we live in a chaotic system. It's inevitable. And part of that chaotic system is that valuations have spiked in most things, in bonds, in housing. This is the stock market. And all it says is that things are overvalued. What could go wrong? Well, in a sandpile effect, the bigger the sandpile gets, the more likely you are to have a slide, just because the more complex the system is becoming. Likewise, the higher the valuations, the more likely a downturn. Next week, I don't know. Nobody knows. 10 years, maybe, might go beyond that. But at some point, there will be a downturn, and it will be temporary. But it is naive of us to think that we can go into this situation with valuations like this and not have a downturn at some point. Part of the problem, or I guess part of the solution, is that massive debt creation is underway. The Federal Reserve is buying bonds, which reduces the supply, which makes bonds more attractive, which drives interest rates down. So there's artificially suppressing interest rates. What happens if that stops? Answer: greater supply, equal demand, lower price, which means higher interest rates. What happens if all these corporations who have taken advantage of this, all of these governments, all these municipal and state governments, suddenly find themselves with twice, we go from say a 2% to a 4% interest rate, and the cost of refinancing just doubled? That implies that this has a termination date on it. It's kind of a buy-sell date on a carton of milk, in the sense that at some point this cannot be continued, it will go bad. What happens? Well, you pour the milk out and get a new batch. So temporary, but usually there's regime change. Fear mongering. Okay. Manufactured emotional manipulations by factions and agencies continues to build angst, anger, insecurity, and short-term thinking. Fear is one of our greatest enemies. And as this book points out, it's been going on for centuries. The only difference now is that the level of input through the internet has gone off the charts. So we are exposed to screaming and shrieking and yowling. A lot of Americans were courageous during the COVID epidemic. A lot of Americans were cowardly tools. I mean, let's face it. If you're at either extreme, shrieking about how the vaccine gives you two heads, or that, you know, you should all get vaccinated and there won't be any consequences, then actually you might be part of the problem. But anyway, we want to work our way through fear, and fear is always a part of investing. And that's my cell phone ringing. Manipulation and cultural pushback is inevitable. We've gone to one end of the pendulum here. If you've watched the social shrieking, it's probably going to get worse, and you'll see why. I am not expecting that to calm down in the near future. And by the way, the lower image here is a civil rights march. So some social unrest, some cultural pushback is good. We want it. It helps our country to grow. In a way, things are getting better. Inflation. Now, this graph by Trading Economics is showing that inflation is spiking. You see that little, I'm going to move my little curtain. See that little spike right there? That's us. Okay, it's spiking. It's nowhere near what it was in World War II or the 1970s. I'm going to get a call and it's going to say, well, inflation is fake. They've hidden it. They've hidden it. It's a conspiracy. They want us to think inflation is low when it's high. Really? The fact is that inflation generically is getting bigger. Now, is it hidden? I don't think so. I think they just had to find CPI, Consumer Price Index, or Producer Price Index. Those measure a basket of goods, gives us a level of, it's like COVID deaths. How are you going to define it? Of course, there's some room on that. But the fact is inflation is up. It was low. As you can see, we went down below zero there after 2008. We actually went into deflation, just like we did in the 1930s during the Great Depression. Inflation is up. What do I expect? I do not expect that inflation is going to stay up for more than 2 years, maximum maybe 3. The reason for that is that self-evidently, inflation will lead to higher interest rates. That will lead to an inability to pay back our massive debt. That will lead to recession, not explosion. It's a possibility because I'm just guessing like everybody else. We all have to guess on this one. We've never done this before. The Federal Reserve, we've never stopped an economy governmentally and then started it up again. However, my guess, given what I'm seeing, and you'll see the data, is that inflation will be limited to the next couple of years. I would be really surprised to see us spin into a 1970s, early 80s style of inflation, because at that point you get utter regime change and big changes in society, and I don't think anybody wants that to happen. So inflation may be big for the next couple of years, probably not in the future. Long-term investment returns are worth looking at in terms of after inflation. I'm getting people calling me and they're saying, what about, what should we move our money into to combat inflation? And my answer is right now we're kind of cautious. We're too cautious. I mean, we have been too cautious for 5 years because we've expected this thing to implode. And every time we get ready for an implosion, the Federal Reserve stimulates. At some point it's out there, but meanwhile, we've been too cautious. What has worked for inflation has been the stock market. If you look at this is after inflation. So you take your inflation statistic and you subtract that from your nominal, that is what you see in the Wall Street Journal, you subtract that out. That's why if you look at cash in the last 5 years, you've gotten a positive rate of return. It's been like 0.05%, essentially nothing, but it's been positive. It's been like 0.01%. Now subtract inflation from that, and the real rate of return, that is the rate of return you have as relates to your spending ability, is negative 0.57%. Last 15 years, same thing. After you take that 2 or 3% of inflation out of there, you get a negative 0.67%. The stock market basically outperforms the bond market versus inflation by about double. And if you take it back 200 years, all the way back to 1821, and if you want to, we can go back farther, but this is compiled by Ben Carlson in his blog, A Wealth of Common Sense. I recommend that blog. It's on the internet. And these are his numbers from Deutsche Bank. Basically, for the last 200 years, 6.66% above inflation. It's hard to believe, you know, you think, oh, I got 10%. Well, 10% minus inflation comes out to about 6.66% or 6.49. These numbers reflect the nominal rate or the newspaper rate of return in the stock market during that same time period of about 10% a year. And bonds did about 3.06. And I think the Federal Reserve lately has and the Department of the Treasury have essentially annihilated the bond market. We're keeping you in bonds, we're keeping me in bonds because they provide a buffer when there's a correction. Aside from that, bonds aren't going to do much for the next 5 years. However, what should we do for inflation? The stock market does a pretty good job. How about commodities? How about owning that lumber that's doing the short-term kick? Lumber's what, 300% in the last year? How about oil? How about getting in there? Well, commodities, because production has traditionally gone up, I mean, they're making more of pretty much everything. Commodities have not kept pace with inflation. Commodities have a tendency to boom and bust more than anything else. We have a little, I mean, we've done well with our energy holdings. We've done well with our value investments, and we're going to do better going forward, I think, because tech is so overvalued. But essentially, cash barely outperforms inflation. Bonds do okay in the super long run. Now, I don't think they're going to do so great, but you got to stay in the stock market. Real estate doesn't even keep up with stocks. Real estate does not, because it also goes through boom and bust. When I do the math on my own house here in Salinas, California, it hasn't kept up with the stock market. Okay, here's the big breaking news. This is big. This is from the Wall Street Journal. And it's from the White House, from the Office of Management and Budget. It's what they expect the economy to do in the next 10 years. They expect a big recovery here. They expect a big recovery in 2022 and a decent recovery in 2023. And then you go below 2% and you have a stagnant or almost stagnant economy, very much like the Obama administration. So they're talking about all this wonderful stuff that's going to happen, but this is what they really expect. Let me go back. I went a little bit ahead of myself. This is what they really expect. They really expect this thing to go stagnant. And why would that be? That would be because maybe they have a pop of inflation, the absolute giant debt bubble that they've created with excessive creation. And maybe it's not excessive. I got to call myself out on that. Maybe it's not excessive because it could be that that's what they needed to get out of the government imposed shutdowns and the natural devastation caused by COVID. So maybe the debt creation was what they had to do. One way or the other, paying it back is going to sap us going forward economically. It's going to hit us. That's what they're saying. Again, this is a guess. Something that could change this, change it dramatically, would be a technological innovation of some kind. A change for the negative would be carried out with a war, say with China, which would be very unfortunate, but possible. Or more social unrest, more domestic violence. Anyway, this is their guess, and it seems pretty accurate. It's what even the conservatives are agreeing is happening. So going forward, it's not the happy, happy, joy, joy that we've been led to believe. What should we do? Well, the first thing is, let's realize that the financial markets go through long-term periods of bust and boom. This is, let's see who this is from. I gotta give you guys credit. Okay, this is from Kessler Investment Advisors Incorporated. So Kessler Investment Advisors made this graph, and it shows something very accurately that we really need to remind ourselves. And that is that we go through periods in all financial markets, housing, bonds, commodities, where things go up too much and then they go down. In Bitcoin, that happens once a day, I suppose. But most of these financial markets have these epochs stretch over decades. We had a really good run here in the stock market. 6.5% annualized real return. And this graph points out that we have to have a negative 45% back to the 5.75 annualized pace. That's probably going to happen. It's going to be temporary unless a meteor hits the earth, God forbid. But it would be very unusual if the global economy went into a long-term correction that did not recover deeply. The percentage money, the smart money, is going to be on a temporary downturn and a recovery. Now, when's this going to happen? Answer: we do not know. It's all guesses. So that explains why we're conservative. But a hard time ahead means we can buy cheap. When we buy cheap, 20 years later, we've got the benefits. Many of us, my clients and myself, have benefited from buying lots in periods of time like 2008. We've seen it before. This is basically the first 20 years of the 21st century. And if you look at it, you can see that the first decade sucked and the last decade was marvelous. And I think we've well, it could be, if we're looking at the next 20 years, that we're going to do this all over again. But remember, a lot of the real bargains happened in here. So if you're not buying it, if you're busy selling, if you're busy running and hiding, if you lack the courage to get in, you're not going to participate in this, which is where we want to be. What are we going to do? Diversification, discipline, caution, and courage. Keep saying this again and again, but it's worth talking about. I don't know about you, but I'm pretty burned out. I mean, COVID has been rough. All the shrieking and yelling and governments intervening and COVID itself doing its damage, it's been brutal. If you're not tired, then I salute you deeply. I'm tired. I'm a little burned out. I'm ready for a good vacation without a mask. But I think we all are. I think we all are. And now, right now, stretching into the next 4 or 5 years is where we need the diversification, the discipline, the caution, and the courage. Now is the time when we pull ourselves up, we rise up, and we focus on our families, we focus on all the good things in life, we focus on making the world a better place, hopefully not by rioting, and we invest with courage and diversification. Now, we're going to stay conservative and diversified, but not excessively. We're not getting out of the stock market, and we're not buying garbage. We're going to stay focused on what has worked historically. The Federal Reserve can keep this bubble inflated for years and years. And what happens if we are in a new paradigm? Some new technological wonder comes along and changes everything. That could very easily happen in healthcare. What happens if that happens and we're in cash? So we don't want to be in cash right now. We want to have some money in the stock market, but we want to be mindful of the fact that there is big risk out there. In the bond market, we want to keep short-term bonds as a parachute for now. Our asset allocation funds, such as our Vanguard Wellesley, are dealing with our long-term bonds. My perception, and I could be wrong, is that it's going to be a tough slide out there because remember, in the last 20 years, when the stock market declined, bonds went up. There's a limit to that because interest rates can't fall much farther. So there's a limit to that. So I think that the next market correction is likely to be brutal and temporary. But bonds should, if they behave like they have historically, and they did in 2020, they did just what they were supposed to do. So there's no evidence they're not doing what they are historically made for, which is a parachute, a buffer, a diversification. So we're staying in the bond market. And we already have a gentle bias towards international values, small cap, and healthcare. I'm going to keep emphasizing that for now. If the market, look, I'm not buying tech right now. We are holding our tech positions, which are between 5 and 10%. I'm not buying any more. If it fell 50%, look, it's a tech world, right? We just figured that out. I mean, 2020 really demonstrated to us that the world is going to belong to tech. So we will buy tech on weakness, but that weakness is not now. Watch out for excess and misdirection, especially in the media. These people are going to be shrieking and wailing. It's going to be the end of the world. Both sides of the political spectrum are going to be shrieking hate and discontent when actually we've just come through one of the worst experiences of American history rather well. I mean, we lost family members, and that's horrible. But in general, we aren't out shooting cats for dinner, are we? So we want to watch out for that media shrieking. Later, I want to point out that to me, the bond market, I expect it to not be worth a darn in the next 5 years. So if the stock market were to correct, say 50%, I would be buying tech, of course, but I'd also be buying dividend-oriented equities because they're the only thing to give us some lift in terms of income, since the bond market is likely to be defunct for a while. At this point, I'm not buying long bonds, but I would if the interest rate spiked to 10%, long bonds fell 50%. I'd very unlikely to happen. That's really not probable. Could happen though, and if it did, we'd buy long bonds. So there's going to be a lot of change in the coming decade, and most of it we cannot foresee. We just have to stay nimble, stay diversified, keep that discipline, caution, and courage. Okay. Let's see. Where I stop the share down here. The $6 million question. There I am, I think. Okay, hopefully this worked. Now, that was my brief. That was my brief of the newsletter, and I welcome any questions. Call me. I'm not going to, since this is going to go out on YouTube, I'm not going to, you have my phone number, you know how to contact me, and I welcome your comments and questions. Yes, there are differences of opinion about the data. No, the essentials are still correct in my opinion, and I'm willing to discuss anything within reason, except for Martians. I probably won't discuss that. Thank you very much. Have a great day.